Thanks for joining us here on Market Call. I'm Morella Fernandez. Bruce Campbell on the show. He's president and portfolio manager at StoneCastle Investment Management. He'll take your questions today on Canadian stocks. Here's how to reach us. Call us toll free at 1-855-326-6266. You can email your question to marketcall@bnnbloomberg.ca. Bruce, good to have you. Thanks for joining us.
Yeah, thanks for having me back on again.
So the name of the game, as you know, has been big tech for months, but you see money starting to move elsewhere. What have you noticed?
Yeah, I mean, we follow a number of different tools. One of them is relative rotation graph. And what we've noticed from the relative rotation graph is that there are some other sectors that are starting to show a little bit more interest on the relative rotation graph and showing that strength. It doesn't necessarily mean that technology is going to die, because it has been so strong. And I mean, that's where the earnings continue to come from. But some of the sectors that have been really beaten up, so for instance, healthcare is now starting to rotate. We still haven't seen much from energy, but that's another sector that we have our eye on. And then the gold sector has been so strong, and we saw that sector moving up, and it's seen a bit of a lull here, but it looks like that's going to start to accelerate again as we head into the fall.
Okay, are you concerned about the valuations, especially in big tech?
I mean, you have to be a little bit concerned. They're stretched up there for sure. There's lots of analogies where they're looking at the same levels that they were kind of back in 2000 before we saw the tech bubble burst that time. And so you always have to be concerned about it. That doesn't ever kill a bull market, though. It's just something you have to be aware of. And it's also possible that what you can see is with more positive earnings, they grow into those multiples, and the multiples then start to decrease just because of the fact that the earnings portion of the equation starts to accelerate at a faster rate than the price does.
We are into the end of August. It's usually a quieter time in the markets. Do you expect September to be volatile, to be quiet? When you look ahead, what do you see?
Well, you always have to expect that that's going to be the case. If you look at seasonality for the market, September is one of the weaker months, as is the first part of October. And so you have to expect that that could be the case, especially considering that, we've seen the markets move so far off the low of April. And now, we're come through this earnings season. We get people back to work, and do they start to take profits or to rotate around? Certainly that is what we've seen in the past, and you can't really forget that that's the seasonality during this time of year.
Got it. All right, Bruce, we're going to line up some phone calls and some emails. Bruce Campbell is with StoneCastle Investment Management. He's taking your questions today on Canadian stocks. Here's how to reach us. We're back in a moment. Welcome back to Market Call. We are going to start with an email right now from David. He says, I'd like to hear your take on Celestica. Is it a buy, sell, or is it a hold? Pulling up the Celestica chart right now to have a look at that. Bruce, what do you think about Celestica trading today at 269, a little bit down on the day, but 260% up over the last year?
Yeah, I mean, it's been an amazing performer. And it really fits into that technology space on two fronts. One is, that they do a lot of manufacturing for different technology companies, and that has really been accelerating. And at the same time, their numbers have been very strong and continue to accelerate. So what we talked about in the beginning of the show was the fact that we're starting, or we could potentially start to see, other leadership, and that some of the technology names aren't leaders going forward. You'd want to watch Celestica, because it is, it has had a very strong move, and certainly the valuation is up there for sure. And so if you held it right now, I would probably, continue to hold it, watch it carefully. If I was going to add to it, or if I was going to buy it, I would probably do it in tranches. So I'd probably add a little bit here, and then I would wait and see if there was a pullback before I added some more.
Got it. Okay, we hope that helps, David. Let's go to Arden from Edmonton with a question. Hi, Arden.
I'd like to ask Bruce, whether you'd buy, sell, or hold Tamarack Valley.
Okay, thank you for the question. We will pull up Tamarack Valley. Is this a company you know well?
It's not, I wouldn't say I know it super well. We have owned it in the past. We don't own it right now. And I mean, what they've done really well is a few different things. One is that they've turned their, their oil production into almost a manufacturing type of process where they buy fields and they just enhance the recovery of those existing fields. And you can see that even with the price of oil not really doing much in the last little while, the stock itself has actually performed fairly well just in the last few months. And I think that's a result of what they've done as far as tucking in and really working into some of their acquisitions that they've made in the past, and then starting to ramp up their production and cash flow as well. So we don't own it right now, but it's certainly one that we've looked at. We've owned it in the past, and if you owned it right now, I'd probably hang on to it.
Okay, thank you for the question today. Let's move on to another caller. Elliot's on the line. He's calling from Hamilton, Ontario with a question. Hi, Elliot.
Good afternoon. Maple Leaf Foods, would you consider this one a steady Eddie? What about this coming spin-off of the bread component? And is it a good dividend grower? Thank you. Okay,
thank you for the question. So Maple Leaf Foods has recently been on an upward climb. It's moved up almost, I'm going to say 15.7% in the last month alone. So what is going well for this company? I know some of these food companies have been sort of lagging behind, as you mentioned, everybody looking towards big tech for money.
Yeah, I mean, there's a few things that have gone in there. I guess to go back and just answer one of Elliot's questions there on it, Steady Eddie, certainly they have been, fairly steady as far as their, underlying business, but the stock does kind of ebb and flow at times. And, most recently it's been, on a fairly good trajectory up for sure. And I think there's a few things that are happening there. One is that, after the big push with inflation, and you saw inflation go up so much, you saw a lot of these food companies really kind of come under pressure because their costs rose faster than they could increase their sales price. And now we're starting to see that catch up a little bit. So they've been able to, justify and get their sales price a little bit higher, and at the same time maintain their costs at a reasonable level where they're not increasing at the same pace. So it has had some more interest. And we don't own it right now, but we run a ranking and a system, and it's actually moved up the ranks quite significantly, and that has to do with both the earnings and then also the potential of the spinoff that he's talking about and what that means for the business as a whole as far as valuation goes.
Do you think it'll be positive for the business?
Yeah, I mean, what you often will see is that, the value that you get from those spinoffs end up being worth more than what they're held inside of the company. So the two pieces will be individually worth, or to combine worth more than what they are as an individual piece.
Okay, we hope that helps him out. Let's go to Dave from St. Catharines, Ontario with a question. Hi, Dave.
Hey, hi. I'd like to thank you for taking my call. Bruce, I was wondering about Royal Bank and where you see it going over the next year or so. It seems to be doing well. I've got my fingers crossed that it continues. Thanks a lot. Take care. Bye-bye.
Thank you for the question. Bruce, where do you stand on, I'm going to say banks in general, because Royal Bank, now at 188, you've been hovering around the 180 mark for a little while. Obviously, it's shooting up again. What is your take on the space moving forward and Royal Bank specifically?
If you look at the banks, they've been actually performing quite well here so far this year. And I mean, that is, kind of with the headwind that everyone's aware of, that we're seeing all these mortgages that were, done 5 years ago that are now starting to come up for renewal. And the concern is that, whether or not we start to see some pressure on the consumer because of those higher interest rates on their mortgages, and what impact that will have on the banks from a credit standpoint, but also just from the general economy. So far, I mean, the market seems to be showing us that that's not a concern. And if you look at the numbers that are coming through from all the banks, they've been fairly strong. Royal Bank is, obviously the biggest in the country. And as far as a longer term investment, I mean, you really can't go wrong holding the banks. They're certainly going to chop around from year to year, but over a 5 or 10 year or even longer time frame, you get increased dividends. You get those dividends, and then you get capital appreciation as well. So it's one of those ones that if you're a longer term investor, it's just to tuck it away and kind of enjoy the dividends and the capital appreciation over time.
All right, we hope that is good for Dave. We are going to take a quick break right now. Bruce Campbell with us of StoneCastle Investment Management is taking your questions today on Canadian stocks. We're back in just a moment. Welcome back. We are going to take an email from James right now. He says, may I have Mr. Campbell's opinion on Fiera Capital FSZ? We are going to pull that up right now. It is about 681 right now. They do asset management. Bruce, Fiera Capital.
Yeah, we don't own Fiera Capital. It's one that from a long-term perspective has done, relatively well. In the last few months, it's been a little bit weaker. It tends to chop around a bit, with markets because their fees are tied to asset management. And as they, grow their assets, they get a larger base of fees. One of the things that's been happening with them is that, they've had a little bit more challenges with some of their institutional portfolios. And so they've lost some, they've, gained some. And then just the general contraction in that industry as far as fees go, they continue to, there's continued kind of pressure on fees. So longer term, they really have to grow mandates and investments in order to be increasing their revenue. And, that's one of those things that has been a challenge. They have a fairly steady dividend, which is nice. So if you're just looking at it from that perspective, it's pretty good. But we don't own it right now. We have in the past, but not right now.
Okay, thank you for that. Let's go to the next phone call. JC's in North Bay, Ontario. Hi, JC.
Hi, I'd like to ask about Kraken Robotics. It's had a pretty good run up. Do you think it's time to take some profits here or let it go a little further?
Okay, thank you for the question. Kraken Robotics out of the U.S. at $3.73. So they do marine technology. Do they benefit, Bruce, at all from defense contracts, that kind of thing, which have been growing?
Yeah, they certainly have, and they certainly feel they will in the future. I mean, this is kind of the next frontier, right? Is ocean, and we know so much about what's happened from a defense standpoint with aerial drones. The same thing is going to happen with submersible drones, and I mean these can be anything from something that would be very small to something that's almost the size of a bus. And they operate, on their own. They operate underwater, and they're going to allow, militaries to really expand in a way they never have been able to under the sea. One of a few of the things that they do really well is they have, some really interesting sonar sensor technology. They also have a very interesting battery technology, and of course, most of these drones that are being built for the future are battery powered. And one of the things that, is important is that underwater, that pressure starts to really build up. And so their battery has a certain pressure sensitivity to it that allows it and is really the leader in the market. Now, they've just continued in the last few years here to have amazing numbers come out. And, kind of every time the quarters come up, we kind of hold our breath. It is one that we own, and we kind of hold our breath on whether or not they're going to meet the quarter, and they do, and they exceed. And they certainly have had, a decent record from that perspective. From a valuation perspective, it has certainly got a lot more expensive than it was before. But when you look at the growth rate compared to the valuation, it's actually really still is quite attractive. So we continue to own it here. If I didn't own it, I would probably try to buy it, maybe buy a little bit here and then buy some more if it was to pull back on, on a quarterly number.
Got it. Out of curiosity, how long have you held it roughly?
We've probably held it for probably around 15 to 18 months, somewhere in that range. We sort of bought it mid last year.
Got it. Okay, let's go to the phone lines again. Sam's on the line from Toronto with a question. Hi, Sam.
Hi, I'd like to have your opinion about kids eye care. It has risen quite a bit, and the PE ratio is about 100 or 105. So what do you think is prospect for the next year or two? Thank you. Bye.
Okay, thank you for the question. I'm not familiar. Kids Eye Care, Bruce?
Yeah, I mean, they're a company out of Vancouver, and they're really, this is really the second time around for the management team. They had another company called Coastal Contacts, which they had a really successful build up and then exit. They've done this again now with Kits Eyewear, and they're really focusing on a few different things. One is online retailing. So as opposed to having bricks and mortar stores where there's a lot more costs associated with that, they have they're all online. And then they've done their own manufacturing as well. So they're able to produce glasses at a fraction of the cost of what you would buy anywhere else. And so they retail and sell, all the big name brands, but they have their own as well. And so you can order them online, and there's a fairly quick turnaround. This management team's done it all before, so they really have a blueprint that they're following, and they just continue to build it out. And in the next couple of years, they want to hit the $500 million revenue range, and it looks like they're certainly on track to do that. And I suspect that at some point in time, the same thing happens with Kits that happened with with their previous company, where it gets bought out by someone. We don't own it right now. We did own it. We just recently sold it after the numbers, not because of anything wrong with the company. Just it dropped in our rank relative to some other companies, and so we replaced it.
Got it. Okay, let's move on to Arya, calling from St. John's with a question. Hi.
Hi, my question is on Thomson Reuters. The stock dropped quite a bit after missing revenue in its most recent quarterly results. How real do you think is a threat to their legal services business from AI? And would you buy the dip here?
Okay, so a very specific question about Thomson Reuters, which has media properties as well, up to 239. So up a little bit today, up 7% over the year. But yes, it did take a hit on recent earnings, Bruce.
Yeah, I mean, this stock's been a darling for quite some time, for sure, where, the data that they sell, both from a legal perspective and from a markets perspective, is something that, is used quite regularly across those industries. Yeah, I mean, the concern of AI certainly has to be there. I mean, anyone who's been on ChatGPT or any of the other AI tools can see that, there's quite the knowledge depth that's there, and how fast that information can be pulled up that's available to everyone. And so does that price Thomson Reuters out? I'd be surprised. I mean, they're gonna compete, and this business has been around for a long time, and they've continued to evolve the business. So while the company missed their earnings, and because it was kind of priced to perfection, because it has been a darling for quite some time, when that happens, like it just did, the stock does pull back. If you have longer term time horizons, for sure it's probably an opportunity here for sure at this point in time. The thing that always happens around these earnings misses is it takes a little while for the sellers to work their way out, and then the next kind of the next move up starts with the company coming out and reaffirming their guidance, the street becoming comfortable that they're going to hit those numbers. And then it slowly starts to bring people back into the stock, and then it starts its upward trajectory. So if you're prepared to, kind of ride out a little bit choppiness here, for the next probably 6 weeks to 2 months, then, this is probably a good time to be stepping in.
Got it. Okay, we do have to take another quick break. Bruce is going to stick around. He's going to share or walk through his past picks when we come back. Stay tuned. All right, time now to have a look at Bruce's past picks. We're going to start with Enterprise Group from September 19th of last year, so under a year ago, on the TSX. $1.89 at the time. It was recommended now at $1.41, so a 25% drop return and a 25% total return drop. This is a construction rental equipment company, Bruce, is that right?
Yeah, they're oilfield service rentals. And I mean, where the opportunity really lies for this company is in their Evolution Power division, which is the ability for these producers, so the oil and gas producers, to generate power on site using natural gas that comes out of the ground. And so it really cuts down on their costs, but also on their emissions. So they recently bought this company, or the Canadian subsidiary of this company, from a US company. And this is where the opportunity lies longer term, because this is an area that they can continue to expand in oil and gas, but then they're also going to try to get into the mining business in addition. The one thing about Enterprise is that, you know, they do ride up and down with the waves of the oil and gas sector. And, you know, they just recently came through their second quarter, which was a little bit lighter than expected due to breakup. That being said, the management team said that they feel that, you know, Q3 and Q4 look like they're going to have fairly strong numbers going forward. So it's one that you definitely have to be willing to have ride up some of those up and downs, or else trade those up and downs.
Have you held on to it?
We haven't. We actually sold out of it around $1.90 range. We haven't gone back into it, but we've just been watching it here recently.
Got it. Okay, let's get to your next past pick, which is Hammond Power, HPS on the TSX, recommended at 141.88, now 126.26, so 11% drop return and 10% total return drop. Obviously, energy, same space, which is volatile, and also oil taking the hit over the last year. Are you still in Hammond Power at this point?
We're not, but they're not in energy. When you think about energy as in oil and gas, they're in energy as in power. And so, you know, what they're doing is they're producing, they manufacture dry transformers, which are used in the power delivery systems. And there's a couple of reasons why their numbers, why their stock price has been down, is that, you know, they continue to see strong demand and have a strong backlog. They're building a new facility right now in Mexico. And they've had some cost overruns in that facility, which has dragged on their earnings. And so as a result, until they get that facility built, there's potential that you could see more cost overruns on that facility, which could hurt their earnings. Longer term, you know, we all know the story of power, and, you know, how much power is going to be used for technology and for AI. And so they will continue to have a really strong market, but they do tend to have choppy quarters.
Got it. Okay, let's get to your third pick from last year, which is Aecon, ARE on the TSX. 2026 at the time, 2020 right now, 0.3% drop, return, total return up of 4%. I guess there's a dividend in there. Construction moving forward, what do you foresee?
Yeah, I mean, one of the thesis, if you go back a year ago, that we had was that, you know, they were starting to roll off these legacy contracts where they were a fixed cost. And what ends up happening with the fixed cost, as we see, you know, costs of their work go up, they only get a fixed price for those contracts. And so it meant that they were losing money on those contracts. Those are starting to roll off. They're still not off, and they're still having an impact. But as they get into variable cost contracts where they're making money, as, you know, even if costs of inflation start to escalate, this should continue to do really well. And they've got a really, really big backlog from a historical standpoint. So while we don't own it right now, it's one that, you know, we think still has a lot of potential, especially as they roll off these fixed contracts.
Let me ask you about construction more widely, because we had Bird CEO on last week, and they've had a lot of projects delayed, right? The business owners don't want to invest the money until they know that the economy is going to be on track for some growth. Is that a problem, you think, generally across the construction space, or do you think Aecon is on the side of that?
Well, I mean, it really kind of depends on the projects that you're working on, right? But that's often the case in construction, especially with these big projects, right? And that, you know, they can be delayed by funding. They can be delayed by a decision where, you know, the business waits to decide what's happening because of, you know, tariffs or the economy or whatever that is. And when you're writing a, you know, big check for an expansion, you want to be cautious on and make sure that, what you're building and when you get it built is going to actually help the bottom line of your business. So that's certainly one risk that you have with these construction companies, is that, they can have what is, considered to be a significant backlog, but it doesn't mean that that backlog translates into actual revenue and earnings in the time frame that you would expect. It usually does. It just sometimes can take a little bit longer. And so, their quarters can be a little bit lumpy as a result.
All right, we are going to take a quick break, lining up more phone calls and emails from Bruce Campbell, StoneCastle Investment Management. We're back in a moment. Stay tuned. Welcome back. We want to go straight to the phone lines. Tony is on the line from Calgary with a question for Bruce today. Hi, Tony.
Hi, thanks for taking my call. I'd like to ask Bruce about a company called K92 Mining, very quietly going about expanding their business, and they're in this process of going to the next level to be a tier 1 producer. What do you think of it? Thanks.
Okay, let's have a discussion about this company, their minerals. They own a gold mine. They're out of Vancouver, and they do have a good chart, up 93% over the year. Do you know them?
We do, yeah. Unfortunately, we don't own them. I mean, they're up, as you mentioned, over 90%, and they've done, phenomenally well. We did own them in the past, and we moved out into a different company. They've done, an awesome job of developing this project, and they continue to develop. And as the caller said, they're moving to the next level. They just continue to increase the production and the size of the mine, and it's certainly one that in some ways we wish we still owned.
Got it. Okay, Tony, I hope that helps you out. Let's go to John in London with his question. Hi, John.
Thanks, Marilla. Hello, Bruce. GoEasy is a non-prime lender that I bought about 2 years ago. It did very well. Then they had an unexpected management problem. They recovered from that, but continued to pull back. And recently they set a high last week, as recently as last week. Is GoEasy an add or just a hold right now? Thanks very much, Bruce.
Okay, thank you for the question. GSY on the TSX at 206.57 today, Bruce.
Yeah, I mean, the company continues to execute really well. They, I wouldn't describe necessarily that it was a management problem. They just had a, sudden departure of the CEO that, kind of everyone was a little bit surprised with, and that did spook the market a bit. Their numbers that they just reported, I can't remember, I think it was last week, were fantastic, and the stock had, a big move up on those, and it really looks like they're, moving into that next phase of acceleration that we've seen from them. And if you go back in history and, kind of watch what they did, they transitioned their business 15 years ago or so now from, the furniture lending business to subprime lending. And they just continue to increase that subprime book, and at the same time keep their loan losses at, a fairly reasonable level. And they've been, been doing a really good job with that. And then just recently, they've started to not transition, but add the auto lending business as well. And so they're starting to get into auto lending, which is, very profitable business as well, especially considering that they have the history that they have with, non-secured lending. They should do really well in this. And it's something that is just rolling out. So I think that you could see the next phase of growth really starting to transpire here with GoEasy. It's one that tends to chop around a little bit because it is, it's got a decent market cap size wise, but it's a fairly thin trader. And so if there's a bigger institution that's trying to get in or trying to get out, it does tend to push it around. And so if you didn't own it, that's where the opportunity lies, is that, as one of those institutions is exiting and they're putting pressure on the stock, you can pick it up, and it often will recover once that selling's done, and vice versa on the way up. If you own it and it's getting pushed up because institutions are trying to get in, it'll often have kind of a spike up before it levels out and then takes the next level. So you can, try to trade around that if you want to do that, as opposed to just being a long-term holder.
They're still in the core business of leasing appliances and furniture?
Not, they still are, but not to the same degree that they were. I mean, they're really, the growth has all come from, subprime is really where most of that's coming now, starting to come with the auto lending.
Got it. Okay, let's go to Jimmy on the line from Langley, BC. Hi, Jimmy.
Hi, thanks for taking my call. I'd like to ask Bruce, what do you think about the Air Canada stock regarding the current situation with the strike? Is it going to dip more? Is it a good time to buy in the next few days? Thank you.
Okay, thank you for the question. And yeah, that's an interesting one, right? The stock really took a deep dive in April, and it really has had trouble sort of climbing back up. Now, flight attendants are on strike, and we're waiting for a resolution there. Would you buy in at 1948 where it is today? Is this a company you expect to see growth in? I'm guessing a lot of consumers are going to be upset about what's going on now. Is that enough to say the company might take another hit?
The airline stocks have always been one that we personally have had a real challenge with. We've never really been good at making money trading airline stocks. And so as a result, we tend to kind of stay away from them. That being said, I mean, there's probably an opportunity here right now, especially given the news flow and the anticipation of what was going to be this news flow. I mean, the rhetoric's been ramping up for quite some time now on the strike and what's happening. I saw analysis out this morning that was just talking about the fact that the flight attendants are probably around a quarter of the employees at Air Canada. And if you look at the wage increases that they're trying to get pushed through, and then also like the time that they would be paid for versus the time that they get paid for now, it wasn't going to be a really significant amount to Air Canada's earnings. I think the analysis that I saw was it would add around about a 2 to 3% cost. So not anything that's, really a huge number. But the headline obviously is what, spooks investors, and how long and what impact that damage could have on their revenue longer term. We know that Air Canada spent a lot of money in the past to really ramp up their business. They're looking to expand internationally, and with really only 2 carriers in Canada, they really have a fairly lock hold on the market. And then internationally, that also presents a fantastic opportunity, and that's where they spent the money recently to expand. And once this gets settled, I mean, that's where you could then start to see the trajectory start to really take off for Air Canada, no pun intended there. But it's one that we just had really no luck in the airlines, and so with so many other opportunities out there, we've sort of stayed away from them.
Got it. All right, we are going to take another quick break. We're going to be back with Bruce in just a moment. Stay tuned. Welcome back. We are going straight to the phone lines. Bill is on the line in Bowmanville, Ontario. Hi, Bill.
Thank you for taking my call. I'd like Bruce's thoughts on Terravest Industries. It's done very well, but the last month or so it's been hurting. Please tell me what you think. Thank you.
Okay, Terravest, we have up on the screen here. It has done a little bit of sinking in the month of August. What do you know about Terravest?
Yeah, I mean, if you look at the longer term, this barely even shows up on a longer term chart, what we've just gone through. And so, they've done a phenomenal job of really growing by acquisition. What kind of one of the sort of big advantages that they have is they have, really good cost to buy steel. And so what they know is that they can go out and buy a steel company, and they immediately will save, just based on their steel price versus what that other company was paying for steel, about 30%. And so it's been a bit of a rinse and repeat story where they've gone out, made these acquisitions, and they're immediately accretive to their earnings. And so the stock's numbers have gone up. In the most recent quarter, the stock started to drift before the quarter was announced. And then when it was announced, it was a little bit weaker than expected. This is a little bit like what I talked about with GoEasy, in that it's got a decent market cap, but doesn't trade a lot of volume. And so as a result, it can really get pushed around based on what's happening with, an institution that may own it. And so we've seen this a number of times in the past where, the stock will all of a sudden have this dip, and then, and that's someone trying to sell it or get off of their position. Once they finish, then, it builds a base and then moves up. I suspect that they still have a lot of runway to go with acquisitions and growth, and they've done a phenomenal job in the past. And we don't own it right now. We have in the past, but certainly we've got a lot of respect for the management team. We have our eye on it right now as to whether or not we start to look at entering back into it.
Okay, Bill, I hope that helps you out. Let's go to Roger from Chatham, Ontario. Hi, Roger.
Hello, and thank you very much, Bruce, for taking my call. I was wondering if you could give me the immediate and long-term opinion on Skeena Resources. It's been kind of steadily climbing, and I was just wondering what your opinion is on it.
Okay, thanks for the question. Junior Canadian mining company out of BC, out of Vancouver. Bruce, Skeena Resources, do you see forward growth for the company?
Yeah, we do. I mean, what they're doing is they're restarting and redeveloping this Eskay Creek mine, and the numbers in that mine, as far as the gold reserve and the cost of production, are phenomenal. And so what that means is that they'll have a really quick payback on the money that they've spent to redevelop this, and then they can continue to expand and grow and have cash flow. With where gold is right now, that also helps tremendously, because when they, kind of made the decision to do this versus where gold is now, it's gone up a fair bit. So it's one that, I think probably if gold continues to increase, then there's going to be an immediate term upside on it. And then longer term, as they continue to develop and build and have cash flow, they would probably expand into other areas as well. So there's, kind of a longer term opportunity in this as well. But again, it's a resource stock, so it's going to go up and down with, with the price of the commodity.
Got it. Okay. Let's go to Lloyd calling from Surrey, Manitoba. Hi, Lloyd.
Hi.
Go ahead.
Okay, so my question is on Bank of Nova Scotia, symbol BNS. It's got a 5.6% yield. Insiders have been buying from $63 to $72. It's at $78.47 now, so not too much above the insider buying. And I guess that's it.
Okay.
Thank you.
So we did talk a little bit about the banks off the top of the show, but let's talk about Scotiabank generally. What do you see for Scotiabank as far as growth goes? And let's compare it again to some of the other banks in the space.
Yeah, I mean, my comments before when we talked about Royal Bank would, be very similar with Scotia as far as, the mortgage renewals, and that seems to be dissipating as far as a fear with investors for sure, and the banks have done well. I mean, the one thing with Scotia is, kind of their growth avenue has been internationally, a little bit different than, some of the other banks where, say, Royal was more, kind of more US and Canadian focused. Scotia's a little bit more Latin America focused. And that area has been certainly increasing from an economic standpoint in the last few months here. And so that certainly helps Scotia longer term. It does, as the caller mentioned, it does have a nice dividend yield with all of the banks. And so again, my comment about the banks when I talked about Royal was that, if you buy these and tuck them away and you hold them for 5, 10, 15 years or longer, I mean, they're phenomenal investments and you really can't go wrong, and you're not going to lose too much sleep because it's not like the Canadian banks are going to disappear, and they've always had, steady dividend increases. So it's, as far as investment in Canada goes, they're going to be choppy from year to year, but, over a longer period of time, they do phenomenally well.
Got it. Okay. Thank you for that phone call. Let's move on to one last email here from Andrew. He says, have I missed a boat on AtkinsRealis? AtkinsRealis doing pretty well. Engineering firm. What's your take on AtkinsRealis moving forward?
Yeah, I mean, they're, really one of their areas of expertise is in the nuclear area. And there's been so much attention now on nuclear power, both from a facility standpoint, but also from a prospective new facility and these micro nuclear power plants that are going to be needed for AI and data centers. And so I think that there's probably still room for this. It has had a nice move up, and so you want to be cautious. If I didn't own it right now, I'd probably move into it in chunks. So I'd buy a little bit now and then, buy it in probably two more chunks if it pulls back, or over a certain period of time, you just, buy a little bit more into it as it goes along.
Okay, that is it for phone calls and emails for Bruce today, but stick around. He is going to share new top picks when we come back. Join us tomorrow on Market Call. Gordon Reid will be on the show. He's president and CEO of Good Read Investment Counsel. He'll take your questions on U.S. equities. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Bruce Campbell. We're going to start with Energia on the TSX, ANRG. They do organic waste into renewable energy. What do you like about this stock?
Yeah, I mean, no one can pronounce the name of it, but we really love the company and the fact that it's a turnaround. So this was an IPO that was done, I think, around 2021. They took on a lot of debt. They almost were failure. They got recapitalized. And now the new chairman of the company continues to buy stock, and they just continue to ramp up. So what they do is they're in the renewable natural gas sector. And so they take organic waste from different sources and really turn that into energy. And if you look at what's been happening with their business from a backlog perspective, what we've seen is that they exited last year, so the end of last year, with about $100 million in backlog. And now, if you add up all of the contracts that they've announced throughout this year, they're at about $260 million worth of backlog. And at the same time, their revenue continues to ramp up. And if you look at the EBITDA for this company, it's still negative. So that's something that viewers have to be aware of. But it's about to transition as they continue to ramp up their revenue to where it will be positive. Once that happens, I suspect you'll probably get a re-rating. You'll have new institutional investors start to look at it. And so it's really that opportunity where the numbers are ramping from negative to positive, and they get a lot of acceleration and momentum behind their business. And there's so much run rate in this sector because what they're signing is they've signed on some big clients that have multiple plants around the world, and they'll take, they'll start with one operation, one renewable natural gas system, and then they'll add a new one. And these systems are around $20 million per system. And you have companies that could have, 20 or 40 of these things around the world.
Got it. So a lot of growth ahead for the companies, what you're saying. Let's go to your second pick, which is Tenaz Energy. So they're a public energy company. What do they do?
Yeah, so I mean, they have production. They had started off with production in Alberta, and then they just recently bought, or actually just recently closed, a deal with a consortium that ran assets in the Dutch North Sea, and these were assets that were really neglected. So that company, or that consortium, had really not been doing a lot for production. They basically just had it almost on care and maintenance, so they weren't spending a lot of money to try to enhance production. So that's the first level of growth that Tenaz will have, is that they're going to be able to go in there with new technology and new capital and enhance the recovery from that field. The second is from an M&A perspective. And if you look at that Dutch North Sea acquisition that they made, it was phenomenal in that you would have never expected this small company from Alberta to be able to buy those assets. But Tony Marino, who's the CEO, used to be with Vermilion. So he's got a lot of credibility across the street. And this just gave him a whole lot more credibility. Plus, late last year, he set up a debenture where it was $140 million, which will allow him to do the next M&A deal that he's working on, and they've openly said that they're working on an M&A deal. You just don't know when it's going to happen. They've tucked in these Dutch North Sea assets, and they'll be working on enhancing the production. And then all of a sudden, one day, you're just going to see an announcement that they bought something else. If you look at the stock price, it's gone up in steps. So it sort of goes up, it goes sideways, goes up, goes sideways. And these are all around the announcements that they have from a news perspective.
Got it. Okay. And all of your top picks, I should mention, are held in your portfolio fund, including your last one, which is MDA Space, which we know does sort of the low orbit satellite. Is that where you see a lot of growth and future contracts for this company?
Yeah, if you've ever heard Mike Greenley, who's the CEO, speak, he talks about the cost of space and the fact that it's coming down so much that it just is enhancing their market in an amazing way. And you've seen that with their backlog. They continue to get, more and bigger contracts for more components, more constellations. They recently just got that EchoStar announcement, and that, was $1.2 billion. But some of the analysts that I saw talked about that actually having the potential to double down the road. So their backlog continues to grow. They continue to execute really well on their numbers, and space as a area to grow is something that is going to continue to expand. As the price to get into space comes down, it just increases the whole market.
Got it. Okay, we do have to leave the conversation there. Bruce, thanks for joining us. We'll see you again soon.
Yeah, thanks so much.
And that does it for Market Call. Thanks very much for watching. We'll see you again tomorrow.